We stand at the precipice of a financial paradigm shift, one that's not defined by market cycles or Federal Reserve policy, but by an invisible, asymmetric war being waged against our wealth. The concept of keeping your money safe has been fundamentally redefined. The bank vault, once a symbol of security, is now a digital abstraction. And the threats are no longer men in masks, but complex algorithms and meticulously crafted psychological operations. This decade, the greatest risk to your portfolio isn't a market crash. It's a catastrophic, silent evaporation of your assets, orchestrated by forces leveraging technologies we are only beginning to comprehend. The numbers are already staggering, yet they represent just the opening salvo. The Federal Trade Commission's Consumer Sentinel Network database logged fraud reports from consumers totaling over $10 billion in losses in 2023. That's a 14% increase from 2022. But what is truly alarming isn't the headline number, it's the vector. The most damaging frauds are no longer initiated by a suspicious email with poor grammar. They are multi-stage, technologically sophisticated campaigns. We are moving from the era of simple phishing to the age of precision-targeted, AI-powered scams. Think of generative AI, not as a novelty for creating art or text, but as a force multiplier for financial crime. Malicious actors can now generate hyper-realistic, context-aware phishing emails, text messages, and even corporate communications at a scale and quality that is statistically impossible for the average person to consistently detect. They can scrape your professional history from LinkedIn, your personal life from social media, and craft a message so perfectly tailored it bypasses every instinct you've honed. This is social engineering on an industrial scale. The next frontier, which is already being crossed, is the weaponization of deepfake technology. We've all seen the amusing celebrity deepfakes, but the reality is far more sinister. In early 2024, a finance worker at a multinational firm in Hong Kong was tricked into paying out $25 million after attending a video conference call with what he believed to be his UK-based chief financial officer and other colleagues. They weren't. They were all deepfakes. The voice, the mannerisms, the video feed, all synthetically generated. This wasn't a speculative, futuristic threat. It was a successful, multi-million-dollar heist. How do you verify a direct order from your superior when your own eyes and ears can be so profoundly deceived? This single incident obliterates traditional multi-factor authentication and corporate verification protocols. It proves that what was once the domain of state-level espionage is now a tool available to sophisticated criminal syndicates. Beyond the immediate, we must consider the horizon. The looming specter of quantum computing threats is no longer a theoretical concern for cryptographers alone. The very foundation of our digital security, the RSA and ECC encryption algorithms that protect everything from your bank transfers to your digital assets, is vulnerable to a sufficiently powerful quantum computer. Shor's algorithm, developed in 1994, provides the blueprint. While the hardware isn't quite there yet, state-sponsored actors and well-funded criminal enterprises are engaged in a race. The harvest now, decrypt later strategy is already in play, where encrypted data is being siphoned and stored, waiting for the day the quantum key arrives. When that day comes, decades of secured financial data could become an open book overnight. Protecting against this requires a forward-thinking approach to post-quantum cryptography, something very few individuals and even few institutions are actively implementing for their personal financial sovereignty. These technological accelerants are deployed within increasingly complex psychological frameworks. The most virulent of these is the so-called pig butchering scam, a term that belies its methodical and devastating nature. According to the FBI's Internet Crime Complaint Center, or IC3, investment fraud losses, largely driven by this scam, surged to $4.57 billion in 2023. This isn't a one-time trick. It's a long-con grooming process. The scammer builds a deep, personal relationship with the target over weeks or months, posing as a successful investor or entrepreneur. They offer advice, share fabricated wins, and slowly build an unshakable level of trust. Then they introduce a proprietary investment platform, often for cryptocurrency or foreign exchange, that is in reality a completely fraudulent application under their control. The initial returns are spectacular because the numbers are fake. The victim, convinced of their friends and their own genius, invests more. They pour in their savings, take out loans, liquidate their retirement accounts. The scammer becomes their confidant, their financial guru. The butchering happens when the victim tries to withdraw their funds. The platform freezes, the friend vanishes, and the entire nest egg is gone. This isn't just a financial loss, it's a profound psychological violation that preys on loneliness and the innate human desire for connection. It bypasses intellectual defenses by targeting emotional vulnerabilities, making even the most financially literate professionals susceptible. This new generation of fraud exploits critical vulnerabilities not just in individuals, but in the financial system itself. Consider the rise of synthetic identity fraud. This isn't simple identity theft where a criminal uses your credentials. This is where fraudsters combine real information, like a valid social security number, often belonging to a child or someone not active in the credit system, with fabricated details like a name and date of birth to create an entirely new, fictitious identity. This synthetic person can then build a credit history, open bank accounts, apply for loans, and participate in the financial system for years. A 2021 report from the Federal Reserve noted that synthetic identity fraud is the fastest growing financial crime in the United States. Why is it so dangerous? Because traditional fraud detection models are designed to spot anomalies in an existing, legitimate identity's behavior. They are not built to detect an identity that was created from scratch for the express purpose of fraud. These synthetic identities are used to bust out loans, max out credit, and then disappear, leaving financial institutions with billions in losses, costs that are invariably passed on to consumers through higher fees and stricter lending criteria. For the individual whose social security number was used, it can mean a decade-long nightmare of clearing their name from a credit history they never knew existed. This speaks to a broader systemic issue: regulatory arbitrage. Criminals operate globally, fluidly moving money and operations across jurisdictions to exploit legal loopholes and enforcement gaps. The rise of digital assets and decentralized finance, or DeFi, has supercharged this capability. While DeFi holds the promise of a more open and accessible financial system, its current state is a wild west of unaudited smart contracts, anonymous developers, and jurisdictional ambiguity. According to the blockchain analysis firm Chainalysis, over $24 billion was sent to illicit addresses in 2023 through cryptocurrency scams and crime. The tools of the trade are rug pulls where developers abandon a project and run off with investors' funds, and flash loan attacks, a type of zero-day exploit against vulnerable DeFi protocols that can drain millions of dollars in seconds. When your assets are stolen from a decentralized exchange governed by an anonymous, autonomous organization, who do you report it to? Which jurisdictions' laws apply? Asset recovery in this space is not just difficult, it is often functionally impossible. The very features that attract users to DeFi, censorship resistance and pseudonymity, are the same features that make it a fertile ground for sophisticated financial predators. So, how do you defend yourself in this new environment? The old advice of using strong passwords and avoiding suspicious links is now dangerously inadequate. It's like bringing a wooden shield to a drone war. We need to adopt a posture of radical vigilance and develop a new framework for personal financial security. First, we must reclaim the concept of financial sovereignty. This means understanding and controlling the custody of your assets. For those invested in digital assets, this is a critical distinction. Not your keys, not your coins, is more than a slogan. It's a fundamental security principle. Relying on a centralized exchange means you are entrusting your wealth to a third party, one that is a prime target for hackers and can be subject to freezes and seizures. Learning to use hardware wallets and self-custody solutions is no longer an optional step for crypto enthusiasts. It is a mandatory element of risk management. Second, our cybersecurity hygiene must evolve beyond the basics. It requires assuming that any unsolicited communication, regardless of how convincing, is a potential threat vector. This means independently verifying any urgent financial request, even if it appears to come from a trusted source. If you receive a frantic email from your CEO requesting a wire transfer, you don't reply to the email. You call them on a known, trusted phone number. If you receive a video call from a family member asking for money in an emergency, you establish a pre-arranged code word or ask a question that only the real person would know the answer to. This zero-trust approach to communication must become second nature. Third, we must rethink diversification. Traditionally, diversification meant spreading investments across asset classes, stocks, bonds, real estate. Today, it must also include diversifying across platforms and custodians. Concentrating your entire net worth within a single brokerage, a single bank, or a single crypto exchange creates a single point of catastrophic failure. Spreading assets across multiple, reputable, and geographically distinct institutions can mitigate the impact of a platform-specific hack, insolvency, or a targeted synthetic identity fraud attack against one of your accounts. Fourth, we need to be realistic about asset recovery. In the digital realm, once money is gone, especially in cross-border transactions or cryptocurrency scams, the probability of recovery is abysmally low. Law enforcement agencies are overwhelmed, and tracing digital assets across blockchains and through mixing services is a highly specialized and resource-intensive task. The focus, therefore, must be overwhelmingly on prevention, not recovery. Investing in preventative measures, whether it's robust cybersecurity software, identity theft protection services, or simply the time it takes to verify information, offers an infinitely higher return than any money spent on asset recovery efforts after the fact. The architecture of finance is being rewritten in real time by technology. This creates incredible opportunities, but it also creates attack surfaces that are broader, deeper, and more complex than ever before. The threats of this decade will not be loud and obvious. They will be silent, personalized, and psychologically acute. They will leverage AI-powered scams and deepfake technology to bypass human intuition. They will exploit the structural weaknesses of our financial systems, from synthetic identity fraud to the regulatory arbitrage of DeFi. Your savings, your retirement, your entire financial future could vanish not with a bang, but with a quiet click, a trusted conversation with a digital ghost, or the slow, methodical bleed of a pig butchering operation. The passive saver is an endangered species. Survival in this new environment demands a proactive, educated, and deeply skeptical mindset. It demands that we become the vigilant custodians of our own financial sovereignty, because in this new war, no one else is coming to save you.